Good day, everyone. Thank you for being here today. In this training session, we will explore the key requirements for financial record keeping and auditing. Our agenda includes 1. The importance of financial record keeping. 2. Relevant legislation and standards. 3. Best practices for maintaining financial records. 4. The auditing process. 5. Common challenges and solutions. Let's begin with the importance of effective financial record keeping. Maintaining accurate financial records is critical for any business. Here's why. Compliance ensures adherence to legal and regulatory requirements, reducing the risk of penalties. Financial management provides insights into the financial health of the business, facilitating informed decision-making. Performance measurement allows for the assessment of business performance against budgets and forecasts. Tax obligations. Accurate records simplify the preparation of tax returns and help maximize allowable deductions. Audit preparedness. Organized records make it easier to provide necessary documentation during audits. Several pieces of legislation and standards govern financial record keeping and auditing in Australia. Corporations Act 2001 mandates companies to maintain accurate financial records and prepare financial statements in compliance with accounting standards. Australian Accounting Standards Board, AASB, sets the accounting standards that must be adhered to, ensuring consistency and transparency in financial reporting. Income Tax Assessment Act 1997 requires businesses to keep records that substantiate income and deductions claimed for tax purposes. Taxation Administration Act 1953 details the record-keeping requirements for tax purposes, including the retention period for documents. International Financial Reporting Standards, IFRS. If applicable, businesses must comply with these standards for financial reporting. Here are some best practices to ensure effective financial record-keeping. Establish a record-keeping system. Choose between manual and digital systems and ensure they are easy to use and maintain. Organize records. Create a logical filing system, categorizing documents by type, invoices, receipts, bank statements, and by year. Maintain accurate and timely records. Record transactions as they occur to avoid missing important information. Retain records for the required period. Ensure compliance with legislation regarding how long records must be kept, typically 5 to 7 years for tax purposes. Conduct regular reviews. Periodically review financial records to ensure accuracy and completeness. Let's now discuss the auditing process, which is essential for verifying the accuracy of financial records. What is an audit? An audit is an independent examination of financial information of any entity, regardless of size or type. Types of audits. Internal audits, conducted by employees of the organization to assess internal controls and compliance. External audits, performed by independent auditors to provide an objective opinion on the financial statements. Objectives of audits, to provide assurance that financial statements are free from material misstatement. To evaluate the effectiveness of internal controls. The auditing process typically includes several key stages. Planning. The auditor assesses the business and its environment, identifying key risks and determining the scope of the audit. Fieldwork. This involves gathering evidence, which may include reviewing financial records, interviewing staff, and testing controls. Evaluation. The auditor analyzes the evidence collected to assess whether the financial statements are presented fairly. Reporting. After evaluation, the auditor issues an audit report outlining their findings, conclusions, and any recommendations for improvement. Follow-up. Management should address any issues raised in the audit report and implement necessary changes. Here are some common challenges organizations face in financial record keeping. Lack of consistency. Inconsistent record-keeping practices can lead to errors and compliance issues. Insufficient training. Staff may not be adequately trained in record-keeping procedures, leading to inaccuracies. Technology limitations. Inefficient or outdated software can hinder effective record management. Retention issues. Difficulty in determining what records to keep and for how long. Time constraints. Staff may struggle to find the time to maintain accurate records amidst their other responsibilities. To overcome the challenges we discussed, consider implementing these strategies. Standardized procedures. Develop and document standardized processes for record keeping to ensure consistency across the organization. Training programs. Provide training for staff on record keeping and auditing requirements, including the use of accounting software. Leverage technology. Invest in modern accounting systems that facilitate accurate record keeping and streamline processes. Regular audits. Conduct regular internal audits to identify and rectify discrepancies before they become issues. Review and update policies. Regularly review record-keeping policies to ensure they meet current legal and business requirements. In conclusion, effective financial record-keeping and auditing are essential for business success and compliance. Here are the key takeaways. Accurate financial records support compliance, performance measurement, and decision-making. Familiarize yourself with relevant legislation governing record-keeping and auditing. Implement best practices for maintaining accurate and organized records. Understand the stages of the auditing process and the importance of independent verification. Address common challenges through standardized procedures, training, and leveraging technology. Thank you for your participation today.